Ladies and gentlemen, good day and welcome to Triveni Turbine Ltd earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rishabh Brar from CDR India. Thank you, and over to you, Mr. Brar.
Good day, everyone, and a warm welcome to all of you participating in the Q4 and FY25 earnings conference call of Triveni Turbine Ltd. We have with us today on the call Mr. Nikhil Sawhney, Vice Chairman and Managing Director, Mr. S.N. Prasad, Chief Executive Officer, Mr. Sachin Parab, Chief Operating Officer, Mr. Lalit Agarwal, Chief Financial Officer, and Ms. Surabhi Chandana, Investor Relations and Value Creation. Before we begin, I would like to mention that some statements made in today's discussion may be forward-looking in nature, and a statement to this effect has been included in the invite which was mailed to everybody earlier. I would now like to emphasize that while this call is open to all invitees, it may not be broadcasted or reproduced in any form or manner. We will start this call with opening remarks from the management, following which we will have an interactive question and answer session. I now request Mr. Nikhil Sawhney to share some perspectives with you with regard to the operations and outlook for the business. Over to you, Mr. Sawhney.
Thank you very much, Rishabh, and a very good afternoon, ladies and gentlemen. Thank you for joining the Q4 FY25 earnings call for Triveni Turbine Ltd. At the outset, I'd like to welcome you to what has been another record quarter, the 17th quarter of growth for the company. And this has been the highest ever annual revenue, EBITDA, PAT, and order booking, along with the record closing order booking for the company in FY25. We had the highest ever revenue of 20.06 billion rupees, an increase of 21%. We had the highest ever EBITDA of 5.18 billion rupees, up 36% year-on-year, with a margin of 25.8%, which is an increase of 280 basis points year-over-year. We also had the highest ever profit before tax at 4.89 billion rupees, up 37% year-over-year, with a margin of 24.3%, which is an increase of 270 basis points year-over-year, as well as the highest ever profit after tax at 3.59 billion rupees, an increase of 33% year-over-year. All of this was done, of course, based on the order booking that we had not only during the year but in FY24. And so again, we're very proud that we have had the highest ever annual order booking of 23.63 billion rupees during FY25, an increase of 26% year-over-year. And this has left us with a record outstanding carry forward order book as of the 31st of March 2025 of 19.09 billion rupees, an increase of 23% year-over-year. Investments including cash stand at 9.87 billion rupees, an increase of 12% from March 31st, 2024. I'll give you a little bit more of an indication as to where our cash stands given the balance sheet and the execution that we had during the month of March. The board has also recommended final payment dividend of 200%, which is 2 rupees per equity share for the financial year FY24-25, which is subject to the approval by shareholders. But this is in addition to the interim dividend of 200%, which is also 2 rupees per equity share of 1 rupee each. Order booking for this current year has grown very well, as I had already said, by 26%. But the product order booking growth has grown by an impressive 38% to 17.41 billion rupees in FY25. The key drivers for growth in product order booking were the finalizations of orders in the renewable energy sector, industrial clients for industrial power generation and heat, power producers, and API turbines. Domestically, order booking was supported by the company's strategic foray into the carbon dioxide energy storage solution, which I'll give more indication about as we proceed. In the API segment, the inquiry base has expanded geographically, resulting in order finalizations for both drive and power turbines across the Middle East, Southeast Asia, Central and South America, and Europe. As a result, the company has achieved its highest ever annual product order booking for the fourth consecutive year, representing a key milestone in its pursuit of sustainable, innovative solutions. This also gives an impression of how we the company is able to introduce new products and solutions to be able to withstand the volatility that exists in end fixed capital formation markets. The company continues to see a good international demand, which is reflected in the export order booking, which has grown by 23% year-over-year to 12.59 billion rupees during the year. This includes orders secured across broad power ranges from key regions, including the Middle East, Europe, North America, Southeast Asia, and Africa. The total consolidated outstanding order book stood at a record 19.1 billion rupees, which is higher by 23% compared to the previous year. The domestic outstanding order book stood at 8.2 billion, which grew by 9% as compared to the previous year, and the export outstanding order book stood at a record 10.9 billion rupees, which is up 36% year-over-year and contributes to 57% of the closing order book. The inquiry pipeline for both product and aftermarket segments remains very robust and is globally diversified. In FY25, the international inquiry book has grown by over 30%, while the domestic inquiry book has grown by an even more impressive 120%, providing a strong visibility to the coming year. By diversifying across geographies, product market, and aftermarket segments, we also aim to mitigate the risk associated with market volatility. While the inquiry book is extremely robust, the market in India has declined as we calculated for FY25 by 10%. This was while we were anticipating Q4 to be more robust in terms of domestic order finalizations. The robust inquiry level of inquiries gives us good confidence that sectors will come back into the ordering into our order book within the coming quarters. A lot of our growth is also driven by research and development, which is a key focus area for the company. We continue to develop new turbines for historic ranges of smaller turbines, as well as for medium and larger range turbines, which are required for a variety of different applications, including for API as well as for geothermal and other niche sectors. But at the same time, the higher megawatt categories also provide us with greater visibility into a broader market that we can cater our products towards. We also continue to develop new and innovative solutions utilizing carbon dioxide as a means for fluid transmission, which includes an order which we have received along with our Italian partner, Energy Dome, with NTPC, which is for a 290 crore order for a 160 megawatt-hour long-duration energy storage project at NTPC's Kudgi supercritical thermal power plant. We're extremely proud of this order as it not only allows a validation of our technology, we will of course need to work with our partner here as well as with the client to ensure a seamless and smooth installation, which will then allow us to validate this in the Indian market so that we could operationalize this as a product segment going forward. The company has also, as I spoke about in our previous conference call, will be investing into expansion of certain international subsidiaries, in further investments into research and development and testing infrastructure, as well as adding a new bay in its Sompura facility. The total capex forecast for this current FY26 is about 1.65 billion rupees, which includes a carry forward of about 8.44 billion rupees from the previous financial year, which is FY25. The capex will not only allow us to augment certain capacity in terms of our assembly as well as manufacturing expertise, but will significantly expand our research and development and testing infrastructure which is required. Apart from the routine capex which is required for maintenance, there will be a further capex in our international subsidiaries to cater to what we foresee to be growth in those markets. People continues to remain the cornerstone of our organizational excellence, and through a focused approach to internal talent development, external hiring, as well as continuous learning, diversity, as well as industry collaboration, we are building a future-ready workforce aligned with our customer-first mindset and innovation-driven agenda. In FY24-25, Triveni Turbine successfully integrated its talent strategy with business priorities, strengthening capability, ensuring leadership continuity, and setting a strong foundation for sustainable future growth. As a globally trusted energy innovator, Triveni Turbines is well positioned to sustain healthy performance in the near term after delivering a strong performance yet again in FY25. This outlook is supported by a robust order booking in API as well as the industrial power generation turbine segments, as well as the market expansion in high potential regions such as the United States. A robust domestic supply chain further enhances competitiveness and ensures business continuity. The aftermarket business also shows promising growth prospects bolstered by an expanding range of offerings including spare parts, services, and refurbishments, designed to cater to a broader customer base of rotating equipment encompassing steam turbines, gas turbines, utility turbines, as well as geothermal turbines. The company's expanding presence in the global market, along with the increasing demand for renewable energy, energy efficiency, waste to energy, and decentralized power generation solutions, continues to present significant and substantial growth opportunities for the company. And we are confident in leveraging these opportunities both domestically and internationally, which will enable us to maintain the growth and profitability in the coming years. To give you an idea on some of the ratios that the company achieved in the current year, the company achieved an EBITDA to sales of 21.8% without including cash. PAT to sales was at 17.9%, and our return on equity annualized on book equity was 33%. And without investment and bank balances, our return on equity was 235%, while the return on capital employed annualized was at 45%, and without return on invested capital without investment and bank balances was a very impressive 307%. Asset turnover continued to be maintained at about 5.9% and a current ratio of about 2.2. The balance sheet of the company remains robust. In the quarter ending Q4 FY25, we had certain back-ending of orders which happened in the month of March, which you'd see from a balance sheet where we'd have higher receivables as well as certain other current assets. Both of these are short-term in nature and would have already been reversed to a significant extent in the month of April to return to our low receivable metric. The company has grown very rapidly in the last 3 years. Between FY22 and FY25, the revenue of the company has grown by 2.36 times with a CAGR of 33%. And in the same period between FY22 and FY25, the PBT has grown by 2.82 times with a CAGR of 41%. Given our growth of order booking of 26% in FY25 as well as an ending order book which is 23% higher, we are confident of growth in the coming year. As what happens with order booking and as well as turnover, some of this growth will be lumpy. But having said that, our inquiry book and our order book gives good visibility of growth for the coming year, and our inquiry book gives a good visibility of growth for the coming future. This, coupled with our innovations in new product introductions and new technology introductions, which will happen in subsequent quarters and subsequent years, gives a good visibility of the company to sustain its remarkable growth in the coming years. Of course, maintaining these high growth rates will be difficult, but we have full faith in the management who have performed exceedingly well, and we are happy to take your questions now.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Ravi Swaminath with Avendus Spark. Please go ahead.
Good afternoon, sir. Congrats on a good set of numbers. My first question is with respect to the API turbine market. So essentially, if you can talk about what is the size of the business right now, what is the size of the industry, and what kind of scale up in terms of business can happen over the next 2 to 3 years, and how and why it can happen.
Okay. Before I ask Prasad, our CEO, to comment on this, we don't give specific market numbers, Ravi, as you're aware. But having said that, as we've talked about over the last several quarters, there are very distinct avenues for growth for the business. which is firstly to maintain its market share in the smaller turbine market, which is below 30 megawatts. At the same time, increase market share in the higher megawatt space, which is above 30 megawatts. While a traditional growth segment of the business has been energy efficiency and renewable energy-based power generation, which continues to be the mainstay of the business, API as a market segment has increasingly become a key growth driver to the business, not only in FY25, but also it showed a little bit in FY24. Going forward, we aim to increase our focus on this market segment, because not only is it focused on customers who demand exceedingly high quality, high efficiency, high technology turbines, but also it is a market segment that provides a certain degree of reliable and routine investment. This is doubled down. This is also reinforced by the fact that we've seen, while oil prices may have come down, the long-term investment both into oil diversification as well as into gas and methanol and other forms of downstream production for the oil integrated majors continues at a robust pace. And so the inquiry book also reflects that in terms of the growth, both domestically as well as internationally. If we look at look at it from a perspective of what segments will continue to exhibit the most amount of growth as far as the growth in our order book goes, yes, you're very right. API will be a market segment which will drive growth, in our opinion, more than energy efficiency and renewable energy. But renewable energy will continue to maintain the largest segment of demand for the company's products. Prasad, would you like to comment on Ravi's question?
Yes, sir. Yes. So good afternoon, Ravi. So in continuation to what VCMD shared that, yes, API inquiry pipeline is quite robust and we are quite bullish, as we communicated in earlier conferences also. So we have been in the approved vendor list of major refineries, petrochemical complexes across the globe, and even last financial year, some more positive results we could able to gain in terms of getting into the approved vendor list, which has given a strong inquiry pipeline. We are quite bullish because we are there in the drive turbines as well as into the power application of the API machines. With that, it's going to be a strong growth driver for us going forward.
Understood. My second question is with respect to the CO2-based energy storage system. So essentially, FY25 we had got a single order from NTPC Kudgi. How replicable is such kind of orders? What is the visibility in terms of scale up of this business? Can this be replicated in more power plants, both NTPC and non-NTPC related business? And if you could talk more in terms of the profitability angle also, because how much component value add that we can do in that project and how much would be outwardly sourced from other external parties. So because of that, how the profitability is likely to pan out? Is it likely to be in line with the overall company level profitability? If you can talk about that.
Yeah, to address it firstly on the margin front, well, firstly, this is a new sort of project for us in a sense. You know, it's a little bit more than just the product being sold, but the margin expectations are in line with our domestic margins. Having said that, this is a developmental project which we are working closely with our partner, international partner, along with the client. And we would not be entering into this if we didn't see the potential for this to scale as a business. This is a much more the opportunity here is very solution oriented to provide a solution for long duration energy storage based on subcritical cycle of carbon dioxide. As you know, Ravi, we've been also developing transcriptical as well as supercritical cycles. So the way as to what is replicable going forward, we'll have to see based on the economics and the reliability to customer. And so before I comment as to how scalable this will be from a revenue perspective for Triveni Turbines, we'll have to just wait and see a little bit. We'll have to see certain factors in terms of how the economics work out, how the reliability works out with the customer. We're obviously very hopeful that this would be a great solution for our customers. But more than that, because you see the current form of providing either chemical-based battery storage through lithium-ion or kinetic-based flow pump storage hydro as energy storage options. Thermal storage is also extremely important, and so the cost parameters already make sense. We just have to see if the rest of it can also work out. Principally, there's no reason why this should not be an alternative in our basket for energy storage for the country as well as globally. But at the current point in time, when we are forecasting and giving forecasts for our inquiry growth, etc., it does not include this as a market segment. Having said that, when you look at the 290 crore order in this Q4, and if you say how much of it was in the historic turbine segment versus the CO2, you also should keep in mind that we did take out some orders because of the high order booking this quarter. We've cleaned up our order booking by taking out approximately 140 crores from our order book of slow-moving orders, which we have advances of. And we're confident because we have advances that these will come back in the medium term. But from the near-term visibility, we've taken it out of our order booking. So this again gives you an idea about the quality of our order book in terms of what can be executed. That coupled by our book and bill gives us good visibility for the year. In terms of what you said in CO2 value addition, the company's scope is again in excess of 50% directly, and so we have good control on costs. Ultimately, we are also viewing this from a perspective of putting our best foot forward. So it's a little premature for us to be able to tell you how scalable this will be as a business. I would imagine by Q3, Q4 of this year, we should be able to give you a little bit better idea as to where it stands. But needless to say, this has come quicker than we thought it would in terms of a market segment for Triveni Turbine. And we are quite optimistic that it will become a distinct market segment for growth in the very near future.
Understood. And my third question is with respect to the US foray. Given the tariff-related ups and downs which are being seen from that country, how do you think about the scaling up of business there, say over the next 2 to 3 years? Is it likely to be largely after-sales related work there, and then we can think about the product exports? How to think about that?
So, Ravi, you've become many different questions within that one question of yours. Let me say, as we currently stand, firstly, as you've seen, I don't think you have our detailed consolidated balance sheet with you just as yet, or it's there, is what we said. But we had in excess of about a 25 crore loss in that subsidiary. And so the results that you're seeing post that loss, which has been an investment into that enterprise. And we believe that enterprise will show good performance, and this is backed by our belief of what we're seeing from an inquiry generation. Initially, we thought that we would use the US subsidiary to cater to our growth in the Americas, which is both North and South America. Given the current uncertainties, and given the customer preferences, we are actually booking Canadian and other orders directly from India. But the marketing efforts are still done from the US subsidiary. So looking at the US subsidiary performance directly is a little. It will take a little bit of time for it to show properly on the consolidated or the individual P&L of the subsidiary. But suffice to say that we believe that there will be a good growth market both from the aftermarket refurbishment segment as well as new product sales. We see the API market in the United States as well as distinct geothermal and industrial power generation, including energy efficiency, as key growth drivers. The US itself, as a $25 trillion economy with the capital base that it has, presents many opportunities. Prasad, do you want to give a comment on the US subsidiaries and how we see it? And maybe Sachin, you can also comment on the capacity augmentation in the US.
Yes, sir. So US, as you mentioned, the pipeline is strong and people started accepting our brand there. And even recent uncertainties, otherwise by this time we would have gotten a little more success from Canada and all directly on our US entity. But those orders got directly onto Triveni Turbines Bangalore because of those tariff issues. Otherwise, we are quite bullish because the way how the inquiry pipeline for both refurb services, that is aftermarket, as well as product getting built up, especially from geothermal, pulp and paper, which are the strong segments in that market. And the competition also basically eyeing for the same sort of a segments, but they also have the same disadvantages or same sort of advantages when it comes to the tariff structure. So that way, we are not really concerned on that. We are quite bullish on that. Maybe Sachin, some point.
Good afternoon. As our Vice Chairman has mentioned, we are going ahead with our expansion plans in the United States. The capex that we had planned, we are on track. There's a little bit of a deferment just because of timing issues, but we are going ahead and we are creating the flexibility in our infrastructure there. So depending upon how the tariff structures take shape, we would have the flexibility to be able to even make turbines there. So relatively speaking, with our competition, we are well poised to tackle the market. The potential is good, tackle the market the way the tariff structure shapes up and be able to go ahead with our long-term plans. Because of these changes in the macroeconomic situation, yes, there might be a little bit of a delay in terms of expanding the rate at which we want to. And as we mentioned already, the Canadian orders and some other orders we have started taking on the Indian entity. But for sure, the US market itself for aftermarket and product is very promising for us. Thank you.
Thank you, Sachin.
Thank you. Mr. Swaminathan, please rejoin the queue for more questions. A reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Amit Anwani with PL Capital. Please go ahead.
Hi, sir. First of all, congratulations for the strong set of numbers. My first question on the international market. So you have highlighted in your opening remark about expanding in global markets, and we have been seeing a very strong performance from exports. The inquiry pipeline is also very strong. Just wanted to understand, while expanding in markets, what is our strategy? How are we dealing with the competition there, or is it the market which is already very conducive for our products there? And what sort of products are highly acceptable for Triveni in the global market? So we wanted to understand more color on expanding global markets and how we strategize that.
Okay, thank you. Good question. You see, when what happens in a capital goods space is the best branding that you have from new order perspective is successful installations of orders by themselves. So as our installations grow internationally, that allows us to gain better customer acceptability and confidence on our product ranges. This stretches not only in our historic smaller ranges, but also in the higher megawatt ranges. And we believe, especially with the higher megawatt ranges and with specialized API or other applications, as more sites are put up for our customers, we will gain better traction. That, coupled with our initiative to be closer to customers through both subsidiaries as well as a more focused sales and market initiative, will also bear fruit in allowing us to capture greater global market share. This is something that we're using as a cornerstone of our international expansion strategy. But it's not expansion. These are not capex related. It's more a question of how can we be more relevant to our customers so that we have a higher chance of conversion of every inquiry into an order for us.
Yes, sir. Secondly, given the very strong inquiry growth which we have seen in domestic and international, and very strong top-line growth this year as well with good margin, can we expect similar to continue for FY26, given there is a good order book and inquiry as well? Just wanted to have some color on the growth trajectory since we are expanding still for the FY26 year.
Yeah, but actually, if you look at it from our revenue grew by 21% year over year, and our order booking has grown by 26% year over year, with our ending order book at 23% higher. So it gives you an idea as to the growth that is possible for the coming year, and we're quite confident to be able to achieve that. What I think you would also find in our balance sheet is that because a lot of the orders were back-ended, actually we have a lot of goods in transit which were not able to be billed directly in March itself, which will come in April. And so these are things that we're already off to a decent start. Q1 will be a little volatile from the company's perspective. There will be growth in market segments, but I have to say that when we look at the full year and our current obligations to fulfill our customers' expectations in delivery, we are confident of growth in revenue of a good manner in FY26 as well.
Right. So lastly, amid all this geopolitical and tariff wars going on, any challenges which you faced? Because I can't see, like, your commentary has been quite commendable and positive. So anything which was...
The fact is that, as you can see, that the domestic market has sort of declined year over year, even though inquiry levels remain robust. So the uncertainty is causing deferment of order placement, even though these orders do need to be placed based on either other capex or other commitments that have been taken, be it financial closure of projects, etc. So I think what you could say is right now is that there has been an elongation of order finalization timelines, and that is something that is a concern. But we'll have to wait and see if this is something that is a one-quarter thing or something that continues for multiple quarters.
So thank you so much for answering my question.
Thank you.
Thank you. Next question comes from the line of Mohit Motwani, Tara Capital. Please go ahead.
Hi, am I audible?
Yes.
Yeah, thank you for the opportunity. My first question is, on one of the charts in the presentation, which shows that how the 0 to 100 megawatt with the steam turbine market, declined from 8.7 gigawatts to 6.9 gigawatts, and we have grown our revenues by 21%. I understand this is a function of, increase in wallet share, market share. Can you give us some idea on, how much has realizations improved on a year-on-year basis from FY24? If not on the company level, at least in the industry level, if you can give some sense on the per megawatt realization, how have they improved?
Oh, the fact is we manufacture a customized product, so every order is distinct in pricing as well as cost. The features that a customer may require it doesn't enable us to give a very generalized number. But having said that, over a period of time, you've seen base material prices rise, as well as the fact of overhead costs. And so there has been an increase in costs in the market segment for us as well as our competitors. But as the market size grows, you've seen an expansion in margins. In the distinct market between FY24 and FY25, as you pointed out in terms of decline in market, there's a lot of nuance in that number. We give that number to give a broader indication of where the market sits. But having said that, we're quite, if we take out and eliminate markets in which we don't participate directly, which is China and Japan, we think that the market is quite robust. Still, our inquiry levels are at record levels, and so we think that presents a distinct opportunity for us. And this is despite the volatility that may have been there for the last 3-4 months anyway. So we're quite optimistic, but our gain in revenue, despite the market decline, is sort of contributed by the fact that we are approaching newer market segments in growth and achieving a higher market share than we have in the past. And I think that's the way that you have to look at it, that we don't capture and cover the entire market. And as we do more of that, the more macro number will be a little bit more meaningful for us.
Sure, that's helpful. And one more question was, when you said, maintaining such high growth rates could be difficult, is that, baking in some conservatism on the export side, given, you have seen some moderation, in the export order in the last 2 quarters. I understand, these are lumpy in nature. We just want to get your perspective on the export order, because I think this was one of the big opportunities for us and has been rather. If you can, elaborate a bit more on that.
Yeah, no, I think the fact is that there's some base effect on some of these numbers as well. And of course, as you point out, these are lumpy. Exports will continue to remain a mainstay for our growth, because not only does it allow us to be relevant, it allows us to benchmark our competitiveness, and the fact is ultimately it's a much higher margin segment for us. So we're quite confident that the export market will continue. to be a key driver of growth for us, and it's actually we need the domestic market to revert. That would be a bigger thing for us. To just clarify your point that I think that you said that we may not be able to maintain the high growth rates. The reason I said high growth rates is because we've had a revenue growth of 33% CAGR over the last 3 years and profit growth of 41%. Now, if you look at those numbers, yes, those are very high numbers to achieve on a higher base. But having said that, we have very high expectations of growth of this on our business, both in profitability as well as revenue. Given the newer market segments that we're entering into, given the fact that we already have a much higher order booking level as well as inquiry book level.
Thank you. Mr. Motwani, please rejoin the queue for more questions. Next question comes from the line of Tina Virmani with Motilal Oswal Financial Services Limited. Please go ahead.
Hi, sir. Congrats for a decent set of numbers. My question is a follow-up question in line with the previous participant on both domestic as well as on the export order inflows. So we've had a fairly decent inflow numbers on the domestic side, but if you remove that one large order based on CO2, overall domestic inflows have declined on a year-on-year basis. So when can we see the base orders for Triveni to start ramping up? Because inquiry pipeline has been fairly strong. But what is stopping this inquiry pipeline to get translated into order inflows? And also, which are the sectors and subsectors within this inquiry pipeline which would materialize first and then which would materialize later? That's my first question.
Yeah. So to put it in perspective, in Q4 we did take out about 140 crores of orders as well. So if we look at that, actually there's been a growth in order booking. Now, having said that, you're right, it's not to our expectations. We did expect domestic orders to be higher than the current level. There is deferment of orders. I'll ask Prasad to give you an indication as to where he sees orders coming in which market segments from the domestic side as well as internationally. Prasad, do you want to comment on the inquiry levels and where we see?
Yes, sir. I will take it like this. So domestic-wise, yes, in Q4, what we expected not materialized because the last year overall domestic market is a muted market. We know that last year 2 quarters for a general election, then another major segment of distillery that is in Maharashtra. There's also election in the 3rd quarter, but we expected Q4 will bounce back. But even though finalizations not took place as we anticipated, but inquiry pipeline started building up. That way, if you see, especially the inquiries from process cogeneration is a strong pipeline, got almost, it is a double compared to the last year. So following with steel, cement, now followed with oil and gas. So that way, if you see, more or less every industrial segment inquiry pipeline is quite bullish because last year whatever orders not got finalized, majority of those things we are hoping that will come for finalization pattern as the inquiries started building up. So we are quite confident. Just now we are also carefully watching the scenario, the current tensions, whatever there. Hopefully things should improve upon.
Sure. So these process cogen, steel, cement, they can be the first one to respond once this macro uncertainty resolves.
Each order is distinct by itself. So, I don't think you can generalize in terms of segments. What we saw because of the unviability of steel last year, that FY2025, those orders were muted in Q3, Q4. With some safeguard duties coming back in, those segments will come back. So there's a little bit of fluidity in individual segments based on their own economics. You'll have a consistent demand that happens from cement based on their capacity expansion for waste heat recovery as well as for brownfield, greenfield expansion turbines. In other segments, be it in recycling is a growth market segment. They're both in paper and paper as well as plastic recycling is a consistent market segment. So is the food processing sector, which requires a different set of turbines. Market segments like pharma and chemicals are a little more muted, but the distillery market seems to be back with some robust demand.
Got it, sir. And my second question is related to aftermarket related opportunities in your target geographies, be it Europe or US, and where do you see this share of aftermarket as a percentage of revenue over next few years? It can be broadly in the same range of around 30-32%, or can it move higher?
No, you see, we're having very strong product sales growth, and it's because of that some of the growth in the aftermarket is getting overshadowed. But the aftermarket is growing in a very robust manner. As you can see, the growth in our EBITDA margins is given by the fact that we have very high margin aftermarket orders, both from the refurbishment as well as the spares and servicing segments. The refurbishment segment, and specifically our contract in South Africa, has moved up the value chain to a higher value-added contract in which the revenue would be slightly lower, and so therefore the margins therefore higher. So while it may not contribute more on the revenue side and therefore percentage of aftermarket as percentage of sales, but these are higher margin. So now if you blend it all, at the end of the day, we're quite happy with the 33% aftermarket as a percentage of sales. Yes, we'd expect it to rise by 1% odd every year consistently, so that it's contributing more, because we believe that the refurbishment segment in specific has a very high growth rate potential. But we're happy at the level that it's at right now, because ultimately we don't want to sell excessive spares to our customers also, because ultimately we want them to be able to buy more products from us and return. And we have a very high repeat customer base, and so balancing that strategy is also very important.
Got it, sir. Lastly, on this aftermarket for US geography, can your capacity expansion or the strategy for growing in US be oriented more towards aftermarket, or it will be more oriented towards product sales, given the current tariff-like situation?
The capacity is fungible, as Sachin had said. So the fact is we are approaching both market segments equally vigorously and with as much focus.
Sure, sir. Thank you. I'll come back in a few.
Thank you very much.
Thank you. Next question comes on the line of Mahesh Bendre with LIC Mutual Funds. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Most of my questions have been answered. Sir, the order inflow last year grew by 26%. So given the current inquiry flow, will we be able to maintain this kind of growth rate for this financial year?
Well, you're putting our ambition is, of course, to exceed it, but we'll have to wait and see how finalizations happen. I think that a growth of 26%, given the fact that we have book and bill within the year, our spares and services have a lead time to execution of anywhere between 2 to 4 months, and so order booking for that segment can go all the way up to Q3, end of Q3, for it to be billed within the same financial year. And for smaller rated turbines, even Q1, a part of Q2 order booking falls into the execution. So despite the book and bill overall order booking, we are given the inquiry levels, we're quite confident that we'll be able to pick up orders which will give us good growth in the coming year, but also visibility for growth in FY27.
Sure. And so what will be our capacity utilization as of now?
We don't really work on that number because we don't have much capital employed. But having said that, we're currently operating on a 2-shift basis, and we don't see capacity as a real constraint. We are adding a bay, which is more from an assembly perspective, and some manufacturing capacity, which is part of our capex plan for the current year, which may spill over into FY27 a little bit also. Which will augment all of this. So we don't see that as the biggest issue.
Thank you. Mr. Bendre, please rejoin the queue for more questions. Next question comes from the line of Chirag Muchhala with Centrum Broking. Please go ahead.
Yeah, hi, sir. So, sir, the question is on the Europe market and more specifically UK, since that has been historically one of our good markets. that recently India and UK have signed that FTA. So just wanted to know that, will this be, very fruitful for us in any way? Is currently whatever our market share or competitive position is, are we relatively, negatively impacted by some of the taxes which will go away? Just your thoughts on this, please.
No, we're not either negatively or positively impacted by it. To the extent that it builds more confidence in the British economy and allows them to have more capacity expansion and capex, that will benefit us. But I don't know if it will. So I think it's just neutral. Most of these FTAs are neutral to us because our product is not heavily taxed as a dutable item both ways. Imports into the country are pretty much at zero duty anyway. So it doesn't help either way. We just need more demand to come into that market segment. The UK presents some distinct opportunities in the municipal solid waste incineration and energy efficiency green power market. That's about it for right now.
Okay. And so second is on just a follow-up question on the capacity. So whatever capex that has been lined up over the next 2 years, so in terms of turbines manufacturing, both in India and possibly in US, what would be the quantum of increase in our capacity that we are planning over the next 2 to 3 years, maybe over a medium term?
So, actually given our high asset turnover and return on capital, but like I said with the last question as well, that we don't have much capacity employed. And so when you look at it in terms of how scalable the business can be, given our current balance sheet of investment and what we're planning in terms of expansion in Bangalore as well as in the United States, what you have to view is the fact as to how many ships are working and how scalable is that. So at this current point in time, when we're working a little bit less than 2 ships on operations, that has possibility of expansion by itself, more than the fact that we have further utilization of assembly capacity. What we're really trying to augment here is more testing ability, assembly capacity. Now, assembly capacity can be constrained at times, but at the current point, we are able to balance and manage in excess of 300 plus 350 odd turbines. Our endeavor to sort of give a little bit more capacity is so that we don't end up bottlenecking operations which happen at times, like, for example, in this March, and so it's worth not having those bottlenecks. And so capacity really isn't the constraint on an annualized basis, but maybe on a monthly basis, there is some issues that we may need to streamline.
Thank you. Mr. Muchala, please rejoin the queue for more questions. Next question comes from the line of Amit Mahawar with UBS. Please go ahead.
Nikhil, hi. Congratulations on great results. Nikhil, my first question is, so if you see fiscal 25 was a year of great performance on product exports, whether it's orders or P&L, but services, I'm not judging services, which is flat in orders this year, but we want to throw some light here on how will this grow in 26 and 27, because you are building your team even for the North American market. That's my first question. Some color on after sales.
Yeah. No. So after sales is an extremely important part of our business for 2 reasons. One is that firstly, it's a high margin segment. But more than that is the fact that it enables customer satisfaction. It allows us to provide the services that our customers need, which confidence is what leads to repeat orders. So it's very, very important from a customer satisfaction perspective. Also, there are 2 segments to growth in the aftermarket. One is our spares and services, which will grow based on the installed base growing. As our installed base, and you sell spares really after some degree of operation of the turbine. So given the growth that we've had over the last several years, those products, like maybe 2-3 years, which have been commissioned 2-3 years ago, will now start coming back and come into the ordering for spares. And so we believe that will continue, but that growth rate will be, I say it has to be done in a manner that we have to take the customer along with us. We can't just be selling excess. The real growth rate for us, which has somewhat disappointed, where we have much more potential to grow quicker, is the refurbishment segment. And it's segments like that which we think can drive a lot of the quick revenue and quick wins for especially the US market. And so we're still very hopeful. This means expansion not only of our sales and marketing network to be able to cater to the varied requirements that may happen in the refurbishment segment, but also technologically we need to be relevant and be able to provide the solution that customers want. So there's an investment in people that's required to allow that market to grow, but we're quite hopeful that from a long-term and medium-term perspective, this is a market segment that we can quite confidently say will continue to grow for Triveni.
Sure. So you've been very measured on your, investments in very select markets. For example, SADCs where you had less than 4 years payback. That gave you confidence to enter one of the world's largest market, North America. Again, and maybe Prasad and team can chip in here if you. What is the size of API services and large machines that we are targeting in 26, 27? What I mean is, in your addressable market with changes now, and I'm talking about particularly 1 to 2 years. In long term, I understand it's a very, very compelling market, and there is a scope for consolidation, especially in services, right, in North America, as you mentioned in the last calls. Particularly next 1 to 2 years, what kind of, large machine orders can we expect in this new market? And some color here on the services. And I was asking more also about the number of, the team size you've built in North America. Thank you.
Yeah, so I'll let them come in on the team size and where they see it distinct. But services for API, because the customers are extremely risk averse, especially on the large integrated oil and gas majors, they tend to favor going to OEMs. There are certain strategies that we're trying to employ to be more relevant with them. At this point in time, I can't disclose those. But we see a market with an opportunity for us to work directly with some of these majors to provide their services, specifically in certain regions. Those will be region-specific strategies. Having said that, we do anticipate larger megawatt turbine orders from the API market. We've had good success in FY25, which will get executed in FY26. And we're hopeful in the coming quarters of redoubling those efforts and getting similar successes on that front. It's a very competitive market, there's no doubt about that. But we're quite confident that given our newer entry into the space, that we'll be able to show some success. Prasad, could you just talk a little bit about the API market, and then Sachin a little bit on the US side, specifically for API?
So API market-wise, as we got ourselves approved on in all the refineries, majority of the refineries, reputed refineries, the pipeline is building up. At the same time, this is a very, very competitive market, and we are fighting with all the competitions across the globe in different territories. And we are very optimistic on API growth because the pipeline is there, acceptability there, technical acceptability also there in that. And second thing here, the differentiation what we bring there is a quick back-end support from India team across the globe for API. API business is, majority of the business is through EPCs and OEs. So when this sort of a business there, what they will be looking is a quick turnaround time on the inquiry to the proposal sort of a thing. These are the areas where we are working on that. So that will give us not really good results in the next 2 years, what we are anticipating on that.
Yeah. Coming to the US market, your query, we have not a very big team in the US, but it is very important to understand that in all markets that we operate in, we typically operate also through a network of agents for assisting us in sales and marketing. So while the strength of our team directly on our roles may be not very significant, but we have people working indirectly for us or for the sales and marketing effort across the country through our extended agent network. Also necessary to understand that some of the workshop-related activities that happen in the US are also subcontracted to the partners that we have developed. So team size is as per our plan, but we are looking at expanding it to almost twice the size that we had in the first year, in the second and third year.
And one more thing here I want to add, especially we are very, very conscious on the cost. As we know, US is one of the expensive cost-oriented markets. So a lot of support, back-end support, as Sachin mentioned, from our partners there, as well as back-end teams from India also supports US team so that there is proper cost orientation is there on that. So other thing is some emerging markets like SMRs, what we are seeing, that the small modular reactors market is one of the markets, which we are hopeful that traction, whatever we are having, that should give some positive results to us in North American market. So those sort of a new markets also, so we got access after having a facilities there in US.
Thank you. Mr. Mahawar, please rejoin the queue for more questions. Next question comes from the line of Sarang Joglekar with Vimana Capital. Please go ahead.
Hello. Can you hear me?
Yes, good afternoon, please.
Yeah, thank you for the opportunity. So, on the 30 megawatt plus segment, I wanted to understand, you said you were gaining market share and you are already maintaining 50% plus in the sub 30 megawatt. So, on a broader level, what are the key factors the customers look for when choosing a turbine? What are the options? Basically, who are the competitors, and why exactly do they go for Triveni?
No, that's a very complex question. Every customer has a different purchase decision. Ultimately, confidence, if you have an installed base in that market segment, in that industry, in that geography, that tends to build customer confidence. And so our growth in market share and in the higher megawatt segment will happen based on more successful installations. And so that will feed on itself, and so the growth there will happen in a more linear manner. You shouldn't expect it to be sort of exponential. And we're happy with that because ultimately we want to grow slowly and ensure that we have successful installation.
Got it. And on the API side, same question to the API side. In the competition as well, we are the players in about.
Sorry, I can't hear you. You're muffled.
Can you hear me?
Yes.
Yeah, same on the API side. How's the competition, and who are the players, if you could name a few?
No, I think it's not worth naming competition, but I think you can Google who are the players in the market segment. Competition exists in all market segments. It's not as if it doesn't exist, and we have extremely well-reputed global technology companies in this space, and so it exists. But at the end of the day, it's a technological product, so the number of competition is limited, and we don't anticipate new competition coming into this market segment.
Thank you. Mr. Joglekar, please rejoin the queue for more questions. Next question comes from the line of Nidhi Shah with ICICI Securities. Please go ahead.
Yes, thank you so much for taking my question. So, my first question was on the margin. We've seen for the last 9 quarters or so that margin accretion has happened continuously. I was basically wanting to understand what is it that is bringing us this margin despite the fluctuations in commodity prices and our input prices. That would be the first thing. Second is that we have spoken continuously about the inquiry pipeline. Would you like to quantify that inquiry pipeline in your opinion? Would that be more back-ended, when these orders would finalize towards the second half? What is your opinion on that?
It seems right now that it would be back-ended, but we are not, unfortunately, we don't give the absolute inquiry levels. You could have a discussion with Surbi, our investor relations manager on this question. But what the first question was that?
Margin accretion.
Margin accretion has happened because of both aftermarket as a percentage of revenue going up, as well as the fact that we have a higher export as a percentage of sales. So both of these factors have contributed positively to the margin. In terms of volatility in raw material pricing and increased overhead cost, those were larger factors in FY2022-25 post the real volatility that we saw post-COVID. I think right now our normal supply chain pricing, which we have long-term rates with our vendors and with subcontractors, etc., continue. So it gives us good visibility, and so therefore the pricing level that is taken by marketing and sales is knowing fully well what the cost would be going into any pricing discussion and negotiation. And so they have a fair idea of the margin level at the time of bidding for orders. So as we look forward, I don't think margins are the problem for Triveni. I've always said that is an area which because it's a customized order, customized product, margins will differ order to order and quarter to quarter. But it so happens that we're getting some operating leverage as well. The fact that we have good orders coming from the export market as well as a higher percentage of spares and service on revenue is all giving confidence that we have space.
Thank you. Ms. Shah, please rejoin the queue for more questions. Next question comes from the line of Prolin Nandu with Edelweiss Public Alternatives. Please go ahead.
Yeah. Hi, Nikhil. Thank you for taking my questions. Two questions from my side. The first one is, while you alluded to some qualitative color on your foray into 3200 megawatt segment, but can you just draw a slightly longer-term picture in terms of it's been now 4 years since we are going solo in this segment, not with our JV partner. So let's say in next 5 to 7 years, what is our aspiration in terms of market share? Can we replicate our market share that we have in 0 to 30 in about 30 megawatt category as well? Can you give some color and some texture, and what are your targets and what are your aspirations for this particular segment?
It's a very complex question you asked, but so in the higher megawatt category, which is one of the largest market segments, is a combined cycle market segment, which is where the steam turbine is used as a bottoming cycle for a combined cycle operation. The typical lead for a combined cycle sale is done by the gas turbine manufacturer, and so that's a little bit more difficult for us to market segment to enter just from a sales perspective, because the lead is always taken by the gas turbine manufacturer along with the client. Now, if you exclude that, which is by far the largest segment, yes, our ambition is to be to achieve the same success that we have in the smaller range, and we're quite confident that we'll be able to get there. We find that even in the other market segment, we will make foray, but it's very difficult to see how that will actually happen. We'd make efforts, but market share gain in like I said, in the above 30 megawatt category, we should assume to be a little linear in terms of growth of market share. In the API market segment, it will be a little bit more lumpy because we're able to get bigger orders and take market share because we have the references in place. So now if you combine both of those, because a lot of the API market, API orders are also in the higher megawatt categories, we think that we could show good growth in this market segment of above 30 megawatts.
Thank you. Next question comes from the line of Naman with Presscon. Please go ahead. Mr. Naman, please go ahead with your question. Next question comes from the line of Bimal Sampath, an individual investor. Please go ahead.
Yeah, good afternoon, Nikhil. Nikhil and team, wanted to understand, what is our plan B? I know we are growing very well, but to maintain this 30% around growth rate, earlier we were talking of getting into this rotating equipments and all that. So, what is our plan B to maintain our 30%, around 30% growth rate over the next 3-4 years? Or is there no necessity for that?
No. There is a very strong need for us to continue with our research and development, which is to not only to ensure that our current product range not only is relevant and expanding in its niche applications, but equally to introduce new technology and new products, such as what we tried to do with our carbon dioxide-based systems. So those research continue. Those continue into other rotating equipments. At this current point in time, given the growth in our inquiry book, we find it's not relevant for us to focus our discussions right now because it won't be material in some of these developments in the short term. But needless to say that it is a concern for the board as well as the management to ensure that we have a steady stream of products which will allow us to expand our entire market size that we cater to on a continuous basis.
Thank you. Next question comes from the line of Harsh Tiwani with Ashmore Group. Please go ahead.
Yeah, hi sir. Am I audible?
Yes. Good afternoon.
Good afternoon, sir. So basically, I had a couple of bookkeeping questions from my side. So I noticed that the debtors for us have gone up, like they've almost doubled YOY, even though revenue has only increased 21%. So is there some payment delay that we are facing, or how should we read this?
Yeah, ask me your second question as well, and then I'll answer both together.
The second question was pertaining to the other financial assets line, which again has grown up exponentially. So anything that we should read into this?
Okay. So on the debtors, you'll see two things. One is the receivables have gone up as well as the fact of other current assets. Both I tried to address in my opening remarks to say that because of some dispatches that were bunched up in March, these are orders which have not really come due for payment by customers because we tend to pay on LC at dispatch, and obviously it's within a period of time that the LC has to be encashed. But we've said that in the months of April, May, that has largely been reversed back to our normal stance of low receivables. Other financial assets are higher because the reflection of FDs which are over 12 months are reflected as other financial assets. But this is all part of cash.
Thank you. Next question comes from the line of Prolin Nandu with Edelweiss Public Alternatives. Please go ahead.
Yeah, thank you, Nikhil, for giving me the opportunity again. In one of the comments on API market, Prasad also said that maybe in the future we will also have a play on SMR, the small modular reactors. Can you touch base as to what are the product synergies between API and SMR? Can you give us some context? Because my understanding was that probably in nuclear reactors, the play for turbine is not that large. So can you just help us understand, is it different in SMR?
No, you see, we provide a product that utilizes the heat generated from whichever source. We're agnostic to how the heat is generated. Is it generated through bottoming cycle of a gas turbine? Is it generated through energy efficiency of a cement kiln in terms of waste heat recovery, or through the the heat generated from a small modular reactor? The concept's the same. The fact is we utilize that to provide either heat requirement for processes or to drive a generator to produce power. So the segment is similar in the sense that is for power generation. The specifications of what Prasad meant is that the specifications of quality are equally, if not more stringent. And that is a bigger constraint in terms of manufacturing technologies which has to be deployed to ensure that the customer is satisfied. For example, the vibration levels in the API market for a turbine are 1/10 of what it would be in the industrial market. This has a different connotation and implication on how the product is configured. So it is with that regard. In terms of the SMR market in specific, we provide a little bit more clarity in the coming quarter in terms of how we're approaching that directly as well as the orders.
Thank you, Nikhil. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you very much, ladies and gentlemen, for joining our Q4 FY25 results for Triveni Turbines. As I said, this was a record quarter, the 17th quarter of growth for the company. We look forward for you to join us in the FY26 Q1 earnings call. Some of the results may be a little lumpy in the quarters in the coming year, but needless to say that we are anticipating another record year for Triveni Turbines in FY26. Thank you again. Goodbye.
Thank you. On behalf of Triveni Turbine Ltd, that concludes this conference. Thank you for joining us. You may now disconnect your lines.